Good morning. Let's go ahead and get started with what is our final Boardroom Insights speaker opportunity of the semester. I'm Doug Hemphill. I'm standing in for Assistant Dean Neese, who is occupied elsewhere on campus, but you don't care who I am. What you care about is who our speaker is, and that's Mr. Rick Lenny. Rick Lenny serves as the non-executive chairman of Information Resources Incorporated, which is the leading marketing research firm. He's also a senior advisor with Friedman, Fleischer & Lowe, a private equity firm. He has served for 6 years prior to this as president and CEO of the Hershey Company, and prior to that, he was president of Nabisco Company. Prior to Nabisco, Rick was president of Pillsbury North America and a veteran of 18 years in senior marketing and sales positions with the Kraft Corporation. Mr. Lenny is a graduate of Northwestern University's Kellogg School of Management with an MBA with honors in marketing and finance. His bachelor's degree is in marketing, magna cum laude, from Georgia State University in Atlanta. He serves on the board of directors of McDonald's Corporation for compensation, finance, and corporate social research committees, Discover Financial Services, compensation, nominating, and governance committees, ConAgra Foods, audit and finance, nominating and governance, and ITW Incorporated, audit and compensation committees. He knows a lot and has done a lot. He's also served on the board of directors of Sunoco, and from 2005 to 2007 was chairman of the board of the Grocery Manufacturers Association and chair of its executive committee. He received that organization's Hall of Achievement Award in 2008. Rick is a member of the executive committee of the Global Advisory Board of Northwestern's Kellogg School of Management, a member of the Board of Trustees of the Museum of Science and Industry in Chicago, the Ravinia Festival in Highland Park, Illinois, and Northwestern Lake Forest Hospital Board in Lake Forest, Illinois. In May 2007, Georgia State named Mr. Lenny to its Business Hall of Fame. Institutional Investor in that same year named him one of the best CEOs in America in the Consumer Food Group. In July 2006, Supermarket News named him to its Power 50, 50 people who drive the food industry, and Institutional Investor magazine named him one of the best CEOs in America in the food category. Georgia State awarded him their 2005 Alumni Achievement Award. Food Processing magazine in that same year named him one of their most influential people in the food industry, and Barron's in that same year named Rick Lenny one of the 30 world's most respected CEOs. In 2004, he was also named Brand Week's Market of the Year. We have got a really top-notch speaker to wrap this series up this morning, so please give Mr. Rick Lenny a big welcome.
Thank you. Thank you very much. Good morning. You can now wake up from the introduction. What that means is I am old to have done all those things. For those of you starting out in your career, what that means is your career is an endurance contest. And we're going to talk about that at the end. I am thrilled to be here. I'm the last of your speaker series, so for those of you who subscribe to the primacy recency theory, recency means me. So you'll have forgotten all those other 6, and I'm happy to be here today. And for those of you who think, despite all those things I might have done, I flunked arithmetic, 4 plus 5 doesn't equal 1, here's what it means. 4 companies, 5 irrefutable truths, 1 career. And that's what I'm going to share with you in the time that we have. This slide shows the 30 companies that comprised the Dow Jones Industrial Average in 1990. I don't know if some of us were born in 1990, but you can look back there. What do you see when you look at those companies? What strikes you about those companies? It's audience participation. Let's go, kids. I'm sorry? Someone said industrial. Someone said old economy. Does that sound about right if you look at the logos? Over the ensuing 20-plus years, half the companies that comprised the Dow Jones in 1990 were dropped from the Dow Jones Industrial Average. I can assure you that it wasn't part of their strategic plan or it wasn't part of their boardroom deliberations to be dropped from the Dow Jones Industrial Average. Here's who comprises the Dow today. What do you see when you look up there? What type of companies? Technology, right? Is anyone here? Is anyone here today? Consumer companies, a lot more consumer companies. Now, these are the companies that comprise the Dow today. How many of these will not be on the Dow 20 years from now through the key part of your career? And how many of the companies are thinking about what it takes to stay at the top of their game, which is how one gets to the Dow? If you could come up with one word to describe what it takes to remain at the top of your competitive peer group in order to remain on the Dow, if that's where you are, what's the one word that might come to mind? What do you think? I'm sorry? Innovation. That's good. Anybody else? Endurance is good. Let's go with relevance. You say, well, that's pretty easy. Relevance makes a lot of sense. Well, let's peel that back a bit. Staying relevant is the ability to deliver a superior value proposition. Okay, I get that. I think I know how to do that. But it's to multiple stakeholders, and that's where the difference lies. In my career, it was primarily two stakeholders. There were consumers and there were customers. One were selling consumer products good, the customers were the retailers, fairly defined set of retailers. But now there's a much broader set of constituents with whom one has to create a superior value proposition. They're suppliers, certainly employees, the communities in which one operates, and special interest groups. Now think of trying to create a superior value proposition for each of those groups where they all have their very unique needs, demands, and their perspective on what your company or your brand should be. That's why it's very difficult to stay relevant. Introduction talked a little bit about my background. I will not bore you with it yet again, but I've been very fortunate to have worked for 4 premier companies across multiple categories, multiple brands, multiple business systems, both domestic and international. If you look at the 4 companies up there, 3 of whom were acquired, 1 almost, and that was Hershey's, and that'll be the story for the very end of my presentation. And here's my now ground. So what's interesting is not that there's a bunch of different logos up there. What's interesting is that my experiences and what I was able to accomplish in 30 years in the food industry has enabled me to do what's called a life of variety from a career standpoint. The IRI is a leading market research firm. FFL is a mid-market private equity firm. And 4 board seats. Now, I don't put the 4 board seats up there to say I'm on 4 boards, but look how different they are. Foods, food retailing, commercial products, which is Illinois Tool Works or ITW, and financial services. So when you think about building your career, it's very interesting the experiences that you will glean and you will collect that go well beyond just whatever it is your core discipline or the major that you're pursuing at this point. Said there'd be 4 companies, 5 irrefutable truths. Let's start with technology is always disruptive. Over the past couple of years, there's been this saying, someone is coming up with disruptive technologies. Do you hear it all the time? I'm going to take you back 60 years and tell you that is not necessarily a new concept. It is always disruptive. Technology is always what moves a market, but it's technology as a means to an end. And for those who follow business and think about the dot-com boom and bust around 2000, 2001, there were businesses who thought technology was the end in and of itself. How many of you grew up and hopefully still consume Kraft singles? I knew I'd get some audience participation. Here's what happened. It was launched in 1950. It was made from trim. In the old days, chunks of cheese for retail consumption were packaged and carved from 640-pound blocks. Well, when one carved by hand, primarily back then, pieces of cheese, guess what? They weren't always uniform, so there was waste called trim. So think of all the money being wasted. So somebody, happened to be J.O. Kraft's brother, he said, wait a minute, maybe we can do something with this trim. So the trim was combined with other dairy ingredients and put on a roller, and someone realized they had to invent a way to chill the roller because the cheese was hot so that they could slice cheese. And he said, that's pretty basic. But think of what that did to the industry. Made from waste. Sales went up 150%. It became wrapped in 1965, which is how we consume it today, and it's over $1 billion business. So technologies have always been disruptive. Here's a cautionary tale about BlackBerry. Anybody know what a BlackBerry is? Your parents might have had them. Wasn't BlackBerry the first smartphone? Didn't we all have some form of flip phone when BlackBerries came out? So it was a breakthrough technology. It redefined business communications, so much so that people still have their BlackBerry while they have their iPhone. But the focus was on security in companies, confidential data, through the IT department. So guess what? BlackBerry, or Research in Motion, RIM was the company, it focused on the head of IT as its end user to convince them that BlackBerry was the right technology for their company. So think of this. They're focusing on the IT person, yet the people who are going to be using the BlackBerry phone are consumers just like us. So in essence, they forgot about the people who already were experiencing the benefits of some type of flip phone when they came out with BlackBerry. So along came Apple. They started with the consumer. Music is a core platform. iPod. Sounds almost quaint now, doesn't it? Anybody still have an iPod? We're looking for the people, the older people in the room. And when the iPod came out, it was amazing. We said, what made us think we needed 5,000 songs in our pocket? But we did. But what Apple did, they invented personalization and customization. Who else does a great job right now with personalization and customization? Who? Android? Who else? Starbucks. Who? I'm sorry, what did somebody say? Who? Dell. Who else outside of technology? Think about how Nike, you can make your own running shoes. Think of what Apple redefined how we as marketers interact and communicate with consumers. So think about that, particularly of those of you in marketing where there's no such thing, and there never really was a mass market, but now it's what can you do for me? How can you do it for me? And what we talk about is the internet generation where we all want something perfect, free, and now. If it's on my phone instantaneously, if I can order it from Amazon instantaneously, why can't everything else be perfect, free, and now? So that's what happened between BlackBerry and Apple, but look what happened. The tail of the tape, the market cap, value of the stock. In April 2006, Apple was 3 times greater than that of BlackBerry, $53 billion at $18.6 billion. In the ensuing 8 years, BlackBerry went down by 2/3, and Apple went up by over 12 times. And look at the value that's been created for nothing more than recognizing how consumers want to engage with each other and have things when they want them and how they want them. Flexible business models required to stay relevant. And I'll get a little, since I'm at school, I'll get a little technical, wouldn't I? Right? I'll get a little teaching in this mode. This is a value chain. This is a very simple expression of the value chain, but it works in basically all businesses. On the front end, there's the create. If you're thinking about consumer goods, it's new product development. It's sourcing, it's packaging, it's R&D, it's all the things on the front end to better understand what it takes to win in the market. Then you start to get more towards the middle of the value chain and make, and that's production. And a little foreshadowing, there's a lot more production being done outside of a company than inside a company. There's move, warehousing, transportation. So few companies now own their own distribution centers, their own warehouses, and their own trucking lines, and then market. And market's at the very end at the consumer side and the customer side, what it takes to win with consumers and what it takes to win at retail. If you think about the make and move side, those are the cost drivers. So the goal there is to capture value. If you think about efficiencies, productivity, it's what it takes to get cost out of the system because no one's going to pay you for increased cost in that part of the value chain. What's really interesting are the value creators, which is on the front end. Do you understand what it takes to win in the market? You know what type of products or services you need to develop, what type of benefits need to be offered to consumers or customers, and then on the market side. Most companies, regardless of industry, are focusing far more on the value creators than they are on the cost drivers. And that's simply because they know where the value can be ascribed to their brands and ultimately to their shareholders. How many of you know Haagen-Dazs ice cream? How many of you like Haagen-Dazs ice cream? Haagen-Dazs has not produced its own pint of ice cream in close to 20 years. I was at Pillsbury at the time, and Haagen-Dazs was one of my responsibilities in the group, and we said our number one goal is to build the brand. And the best way to build the brand is to have somebody else manufacture it for us, obviously in keeping with the high quality standards for Haagen-Dazs. But we knew we were much better brand builders than pure producers of ice cream. And that's being played out across many, many industries. I'll give you an example of a flexible business model from when I was at Hershey. I got to Hershey in 2001. The international business was very small. Hershey had done a terrific job building its business domestically, while Hershey had been very important to the GIs in World War II. At the end of World War II, while Mars and Nestle and others stayed in Europe, Hershey came home, and so Hershey focused on the U.S. business. So we said, what's a way to go about expanding globally for Hershey? And it couldn't be done, there's two ways. One's a Big Bang Theory, where there's a mega merger with another company, and for a lot of reasons that couldn't happen and wasn't going to happen for years. The other one is called a string of pearls, where you put together businesses where when you add them together you have a global presence, yet each business operates autonomously within its geography. So Mexico, Hershey had a presence in Mexico, but it was underrepresented until we acquired Pelon Puerto Rico, which is the little guy in the lower right there. And Pelon Puerto Rico to children in Mexico is like Lunchables to children in the United States. So it immediately changed the way by which consumers in the retail trade thought about the Hershey Company. It gave us access to a very important segment, which were kids, and got us access to a very important class of trade, which was mom and pop stores or down the street bodegas. So that was a huge opportunity to dramatically change the profile of Hershey in Mexico. Then we looked at the market of India. India had a very underdeveloped chocolate market, had a decent sugar confectionery and non-chocolate market. And when thinking about how to compete in India, and when thinking about how to compete outside of the U.S., many times food companies, or food and beverage companies, will look for partners who are similar to them. That's not the best way to do it. For Hershey in India, the goal wasn't to combine with another confectionery company. The goal was to find somebody who had a route to market, because we knew very little about what it took to be competitive in a market as diverse and new to us and emerging as India. So we formed, at the time, Hershey formed a joint venture with Godrej, and think of Godrej as either the Procter & Gamble of India or the General Electric of India, and they had a perfect route to market. They understood the retail trade, and it was a very good way for Hershey to enter that market. China was a different story. Lotte, you see the logo on the bottom right portion of the slide, is a conglomerate based in South Korea, but with operations in China. And so Hershey and Lotte formed a joint venture to operate within China. Same type of thing. Lotte had a route to market, but you can see from the labels and the products up there, it was very important to have products that appeal to local taste preferences. It's somewhat easier to take non-food products, whether it's paper goods, it could be personal care products across the globe, because there's not as much regional local preferences excuse me, than there are with food. So you can look at the products there, very different from a Chinese consumer perspective. In fact, the kisses on the bottom left are green tea-filled kisses. They're pretty good. I'll let you think about that for a moment. So those were three opportunities for Hershey to go global. And in the early 2000s, about 5% of Hershey sales were international. Now it's over 20%. So a flexible business model can work. Value. Excuse me. Value is only in the eyes of your customer. You may think your brand has a lot of value. Your suppliers may tell you your brand has a lot of value. That's largely irrelevant. It's what consumers or your customer thinks about value. Let me give you a concept here called the bow tie phenomenon. As a marketer or as a company, you have to be able to compete on both the value-oriented side and on the premium or high-end side, and a company has to be able to do it at both. Think of Gillette. Gillette wants to sell battery-powered razors with 22 blades and flip tops in the U.S. That's great. In India, portions of China, Latin America, they need penny razors, and you have to be able to know how to compete on both ends of that. Here's a retailer who does a terrific job. Anybody know about Costco? Major club customer. I think about $13 billion for just the Kirkland brand. That's their private label brand. The name Kirkland is because they're in Kirkland, Washington. That's where it came from. And they have Kirkland Signature, excuse me, which are paper towels, very low involvement, high household penetration, frequently purchased, but nothing very exciting about paper towel. Costco happens to be the largest seller of premium champagne, Dom Perignon, and the largest wine seller. So here's Costco. They understand how to compete at the low end and how to compete at the high end. And when one goes into a Costco, you'll see both these products in a basket, meaning the Kirkland brand as well as Dom Perignon. And it's a far cry from where it used to be, okay, I can figure out the socioeconomic or demographics of the buyer, excuse me, by virtue of what's in their shopping basket. That is no longer the case. Another way to try to create value, particularly in a slow growth economy, is through new products. Here's what happened. As the economy was slowing post-recession 2009 to 2011, there were 1,591 food and beverage items introduced on average. It exploded to 1,862, or 17% increase in 2012. You can say, well, that's interesting. That's a lot of new products. New products are tough. Here's why. Look at the pyramid. Pyramid shows you the level of sales reached by new products on average. Year one sales, 75% are fewer than $10 million. Now think of, you say, well, $10 million, that's a lot. If you do the arithmetic, tens of thousands of retail stores, how many sales are those per store? What's the velocity? It's not a lot. And the fact that we continue to introduce new products and fail shows that we don't have a good sense as to what consumers really want versus what they're telling us. So new products are fraught with difficulty in terms of being introduced. But I'm going to give you one success. This gray hair came from all the new product failures in my career, but here's one success, and that's mini Oreos. When I got to Nabisco, I started to ask about, what about minis? And there's this marketing concept you'll see later on in another example about making products small and minis. And they said, well, we tried mini Oreos once. I said, what happened? Well, we made it in Canada. Red alert. The Oreo formula in Canada was formulated for the Canadian taste. It wasn't formulated for the U.S. taste. Okay. All right, I got that. It was in a big box, overpackaged. Red alert too. Don't overpackage your product. No one pays for packaging. And it was expensive. Red alert 3. It's overpriced. So we had a different tasting product in an irrelevant package at a high price. That has to be successful. That has to work. It failed. So the lesson there was, well, they said, well, we tried it and it didn't work, so why don't we try it and think first about the consumer? So here's what was developed. Let me explain a couple of things about mini Oreos. First, the product. Fabulous product. Women love mini Oreos. Women love mini Oreos more than men love mini Oreos. Why do women love mini Oreos more than men love mini Oreos? Susan and Sarah, you can't answer because you know the story. Why? Come on. I'm sorry? Fewer calories, it's close. When a person eats a mini Oreo, they pop it in their mouth. When you eat a regular Oreo, you bite it. Women care more about the chocolate that remains in their teeth than men do. And that's why mini Oreo wasn't just successful with women, but that was one of the key insights we got. But there was something else. When we came out with mini Oreos, it enabled us to do so in different packaging and forms. You can see the cup holder in the bottom right. Over the big bag, Oreo Mini. What that enabled us to do was to get Oreos into convenience stores. At the time, convenience stores was the fastest growing, most profitable class of trade, yet Oreos had only 2% of its sales from convenience stores because it had an inconvenient package. So when you think about new products, you think about, yes, are you delivering a consumer benefit? Are you doing something the consumer wants? But it does also give you an opportunity to broaden your presence in a food business, that broaden your shelf presence and be able to get you additional points of distribution. So that's one success there with mini Oreos. Let's see. Pricing is a powerful lever regardless of the business. How many of you have studied pricing? Taken economics? Pricing, there you go. And you talk about, may study elasticity or lack thereof. Let me give you a couple of perspectives on pricing. More often than not, we're focused on the wrong C. We're looking upstream at cost and commodities. We think commodities go up, we have to take pricing. We're thinking about the input cost. We're not thinking about what the impact might be on our consumer or customer value proposition. So we've been focused upstream, on the wrong C, and we do so on an ad hoc basis. Pricing, costs go up, take pricing. It needs to be viewed holistically from a consumer, customer, and competitor standpoint. What will the pricing impact be in the market? What's your pricing strategy? It can't be as simple as, well, pricing goes up or goes down, costs go up or go down, therefore I'm going to simply react by raising or lowering prices. And what needs to happen, we need to shift the debate from cost to net price realization. Net price realization is a terrific opportunity to create value in your business by doing things differently than just a monolithic cost up or down, pricing up or down, product upsizing or downsizing. Frito-Lay's done a terrific job with this. Higher margin new products. I'll show you some in a moment, but that was part of the mini Oreo story. Not all customers, classes of trade, and channels are equally profitable. Costco, the example I showed before, even though they have very low prices, is a very profitable channel and customer for manufacturers because products are shipped in pallets, so you don't have all the extra packaging and distribution. There's no in-store labor, so one doesn't have to have their sales reps go into Costco. So think of that as a very efficient way to distribute and market your product. So think about which customers and channels are more profitable at the end of the value chain as opposed to, let's say, up front just at the gross margin level. However, there are times, and it could be a very price-oriented business, where pricing is required. If you're a coffee business, it's commodity-oriented, you have to take price up quickly. Price to the current environment. You might hear the term, well, our costs are covered. We don't need to take pricing because we did forward buying 6 months ago or a year ago, and we're covered at a much lower cost. Don't do that. If the market is expecting prices to go up because they know your costs are going up and your competitors' costs are going up, take your pricing when the market sentiment is with you. And here's a dirty little secret. If you're covered with good cost and your two major competitors take price increase and their prices go up on the shelf, the retailer's going to take your price up as well. Because if items are typically line prices, if it's a very competitive product category, the retailer's going to do what you should have done, and you will not get advantage of that. They will. So make sure you price at the appropriate time when sentiment is positive, but also be prepared to do it on the backside as well. Anybody know Reese's Peanut Butter Cups? Holy grail of snacking, salty sweet. Anybody who can sell a snack that's salty sweet is guaranteed to do well. This is a $1 billion brand. And we said, what are opportunities to get net price realization, or what we've referred to before as stealth price increases. You just take a walk around the slide. Reese's Dark, inclusion of dark chocolate. When dark chocolate became a very strong trend a few years ago, and there was an opportunity to price that differentially from other Reese's. You can see Reese's Bites, new form, new package, more profitable. Convenience stores, more profitable class of trade. We'll skip over Elvis for a second. If you look at the left side, you see at the top Reese's Minis, make it small. What do you see under it? Reese's Big Cup. If you're a marketer and you're marketing food, make it bigger, make it smaller. You have consumers interested in both. And my favorite, which is in this middle row there, it's Reese's Inside Out, where the peanut butter was on the outside and the chocolate was on the inside. I always wanted to introduce that at April Fool's, but I didn't get too far with that. So you can see CEOs don't have nearly the leverage that you might think that we do. So those are opportunities to achieve net price realization. Here's two that didn't do it so well, and one's communication, and another one's a change in strategy. This is Netflix. In July of 2011, they did a new pricing structure. And I don't remember the specifics, but it was basically you're going to pay more, and they didn't do a good job of communicating why you're going to pay more and what you're going to get for paying more. So here's what happened to their stock. It was well over $300 a share and lost about half within a year and a half's time. That's not good. It may have recovered now, but that's a lot of pain along the way. Second one is JCPenney. Here's one that's very interesting. JCPenney got a new CEO, came in from retailing, but a much different, consumer and retailing, but a much different industry, and they stopped couponing. Well, what they didn't realize, and the stock price shows it, what they didn't realize is that the consumers who shopped JCPenney loved the benefit of the couponing. They said, we're going to quit couponing, and we're going to go to something called everyday low price. Well, what happens if you go into a JCPenney's? The first time, the product went from $17 to $12. And then if every subsequent time you see that product's at $12, do you think you're getting a deal? Do you think you remotely remember that it was ever $17? Consumers voted with their feet, as did investors, and had an 82% drop in share price. CEO lost his job, and they've now returned to coupon. You can say, well, that doesn't make sense for Penny. They're still not successful or aren't successful. The difference is they had a major change in strategy that flew in the face of what their consumers wanted when they came to JCPenney. All right, now's time to wake up. I was with some Notre Dame students last night, and they said, well, we've had these speakers before. Can you tell us a story? I said, sure, I'll tell you a story. You may not like it, but I'll tell you a story. But what does this mean? Leadership is the only SCA. SCA stands for Sustainable Competitive Advantage. What I mean by that is, regardless of the industry, and you'll tell me that this isn't correct, but it's more true than not. Regardless of the industry, we're essentially selling to the same consumers. In consumer goods, we're essentially selling through the same classes of trade or the same customers. So the strategies are eerily similar. So if the strategies are eerily similar, how does one win? It's execution. And what does execution take? Superior leadership. So I'm going to give you a story about a Hershey experience that required a different type of leadership for me, and hopefully that'll convey some principles of leadership. And we're not yet in the home stretch, but getting close, and then most important, we're going to end with what's in it for you guys. So I showed up in April of 2001 as the first CEO from outside the Hershey company in 108 years. It was a shock to both our systems. I also happened to have been the first CEO who did not grow up through the financial side of the business, meaning someone that had a marketing, sales, and operations background. Another shock to the system. So let me orient us to the slides, because you're going to see a few of these. Look up at the top. It's a calendar. Calendar is 6 months, March to September of 2002. And the title says, Guess Who's Coming to Dinner? In March of 2002, now I got there in April 2001, so I'd only been a CEO for 11 months. We were just executing what we thought to be a good strategy. and we hoped that it was. So I was asked to have dinner with 2 members of the Hershey Trust. And the way the structure of the company was, and I won't get into too much detail because that's not the point of the story, Hershey's a publicly traded company, yet the Hershey Trust has voting control, although they don't have economic control. So there's the way the shares are, or the way the capital structure, let me do it that way, the Hershey Trust has voting control, but not economic control. That's in the public. So the Hershey Trust, I had dinner with 2 members of the trust. They say they've decided to explore the sale of the company. Well, I've been there 11 months. Hershey can never be sold. The trust has controlling ownership. Well, what had happened in 2001 and 2002, anybody know about Enron? WorldCom? There was a concern about alleged child labor practices in West Africa where cocoa came from. There was pressure from the Pennsylvania Attorney General, Mike Fisher, who we'll get back to him in a moment, to diversify because Hershey had done well, and so too much of the trust value, and the trust was there for the Milton Hershey School for underprivileged kids, was too concentrated. So think of it as having all of your assets in one chocolate bar. And they said, we have to explore sale of the company. I was obviously floored. Then I go, okay, what do I do now? Newly minted CEO, what do I do now? Well, you can't stick your head in the sand and hope it goes away because that's usually not a good way for a CEO to do. So immediately got together with the board and immediately got together with our advisors and said, we need to do something as an alternative because we can't, for all the right reasons, from a company standpoint, from a community standpoint, the right thing is not to put the Hershey company up for sale. So that was what, March? So 2 months later, we went back to the trust and we said, there's a better way. We provided to them options to explore that were outside of selling the company, ways to monetize some of their investment without giving up control. So that was on May 9th. A day later, they go, nah, good idea, thanks. Let's pursue a sale. So here's what happens. I go on behalf of the board, and I go meet with the 5 CEOs of these companies on the screen. So I go over to Vevey, Switzerland. Peter Brabeck was the CEO of Nestle's. And I know Peter. I said, Peter, let me tell you what the situation is. Peter's answer I heard 5 times. You can't be serious, and I don't believe you. I said, no, I am serious, and you have to believe me. And the company, the trust is we have to explore a sale of the company. And so at that point, we know we go into full sale mode. And I skipped a date, but in July, so this happened in March. It's all in secret. We have advisors, investment bankers, boards, lawyers, et cetera. And it stayed confidential till the news broke in July, which was unheard of that it didn't leak sooner. But here are the headlines that came out. And you can't read this, but I'm going to read. This was my favorite. Hershey and Philip Morris go together like chocolate and poison. Milton Hershey helped orphans. Philip Morris creates them. And these were, and remember I had been at Kraft. Philip Morris had bought Kraft, so there was a conspiracy theory that I was brought in by the trust to sell the company because I came from Kraft and I was going to sell it back to Kraft. There were enough conspiracy theories to go around. But, oh, I forgot a part of the story. Crazy. This started in March. In April, there was a little bit of a labor issue, and in April, there was a strike against the Hershey company. So in the period of April and May, I have the distinction of presiding over the longest strike in the history of the company. I'll come back and give that for crisis management for the next lecture. So here we are working on behind the scenes, now it's public, this potential sale process, and having the strike ended 6 weeks later. You know, these CEO jobs aren't all that they're cracked up to be. So then, here's what's important. Over that summer, I had 2 things to do, and I don't like the use of the word I, but I don't have a better word to use it because it was me. I had 2 jobs to do. 100% of my time was devoted to the sale process, and 100% of the time was devoted to keeping the business running. Obviously, it's not 200% of the time, but One of those, remember we were just a year into our value enhancing strategy. We were getting this company on track. And the first one was we had to go through the sale process. I've been a part of sale processes before. I've never led one outright. And good friend of mine, Steve Sanger, the former chairman and CEO of General Mills, he has a great quote. He goes, what do you do when you're going through hell? Keep going. And it's had a job to do, and you keep doing your job the best you can. So, Bill Wrigley, who was the family member and the chief owner or major shareholder and chairman and CEO of Wrigley, presented to the trust an acquisition offer of $89 a share, which was a 39% premium to what's called the unaffected price, meaning before it went public. I'll show you that in a moment. It was a great offer. In 2002, that was a great premium for a company of Hershey's assets where there was a belief it would never be sold. Next day, at midnight, trust says, I get a call from the CEO of the trust. We've changed our mind. We've changed our mind. It's like we've changed our mind as to what day the company picnic's going to occur. And that was it. And they were the ones who started it, and they're the ones who called the sale off. And I'll give you one cute story just as an aside. We were all at a hotel in Philadelphia, and this was at midnight. And so no one's sleeping because we have to have a board meeting the next day, and we have to issue a press release, and everybody's running around crazy. So I called for room service at 3 in the morning. And she goes, it's going to take an hour. I go, what are you talking about? She goes, what are all you people doing up? Because everybody was up going through the same thing. So here's the press that came out after Chocolate Meltdown sale was stopped. Now, let me, remember I mentioned, for those of you who are really paying attention, which I hope is more than just my daughter, that Mike Fisher, the state attorney general, had instructed the trust to pursue a sale because they were concerned about diversification or lack thereof. Mike Fisher, he was the one who worked hard to block the sale, so in essence, there's a perception that he started the fire so he could put it out. But in the twisted irony of what happens in real-life business, at the conclusion of the sale, no sale, 10 board members were asked to leave the Hershey's Charitable Trust, and I was added to the trust. So think of that. Having gone through that all through the summer, and I had not been a trust board member, I was added to the board of trust, and I was added to the board of school managers. So what did we do? Where were we? That's what I said. It's the first town hall meeting I had after the sale price. I said, where were we? And so for the next 2 years, we were spent restoring growth and morale. And I used that $89 per share that Bill Wrigley was going to give as a takeout premium. I used that as a rallying cry, and I said, we know the company's worth $89 a share. Now we need to get there the old-fashioned way through fundamentals, and that's what happened. July 24th, $62.50 was the price of a share of Hershey stock. Before the announcement went public, if you remember when it went public, jumped up because of a takeout premium. The day after the sale, no sale was disclosed, it went down. A year and a half later, or a little bit under 2 years, we hit $91 plus, eclipsing the takeout premium. That's pretty good for a company to be able to, in under 2 years' time, take out a takeover premium. So if you look up at the top, please remember that one of the key tenets of leadership is a willingness to make the tough calls, and a willingness to make the tough calls when it's not so obvious to others that tough calls need to be made. So here's what happened in the time we were at Hershey. The S&P 500, this is TSR, total shareholder returns, which is a combination of stock price appreciation plus dividends reinvested in the stock. TSR went up 38% for the S&P 500, NASDAQ 30%, and Hershey outperformed both at 64%. I tell you all of that to get to this, and that's not as negative as it seems. It's quite positive, that your career is your responsibility. Ask for opportunities. You will be shocked at the degrees of freedom that you have to do new things at a company, to do different things. Raise your hand. If you're asked to do something and you say, well, that's not really in my area, or maybe it's out of my comfort zone, you can say no once. You don't want to say no twice, but ask for opportunities. There are plenty for you. View your career horizontally, not just vertically. From my career, I spent time in sales. I spent time in line jobs, did some international work, Think about if you're a marketer, well, maybe I want to spend some time in operations or maybe R&D. If you're in sales, think about something else. If you're in finance, think about another opportunity. There are plenty of opportunities without getting in the way of what you think your career track is to go horizontally as well as vertically. We all fail. Failures are a given. Accept it, learn from it, and move on. And don't languish over it. Here's one. Listen to the opposition. Don't dismiss it. What's the old expression? Are you listening or waiting to speak? So many times when we're having a debate with someone in a business situation and we're giving our point of view and they have a different point of view, we're sitting there figuring out ways, how do we defend against it? You don't always have to be right to do the right thing and get it done from a business standpoint. Ignore the clock. Unless someone says they have to be a doctor and go to medical school for this many years and then residency, please ignore the clock. Don't think about, I have to be a vice president by the time I'm blank, or in our world it was marketing. We didn't say, oh, I have to be a group brand manager or vice president of marketing by X date. Don't do that. I don't like to use the word don't, but I don't know a better way to state that positively. You'll make yourself miserable. It's not a race to say, what can I do by certain time? Because when you get there, you go, I don't even remember the journey along the way, so please ignore the clock. The 7 ingredients, my 7, you probably have your own, of a successful career. Capabilities, that's necessary but insufficient to be successful. You're all going to get the job you have, someone's hiring you because of your capabilities. So a good friend of mine, Jim Kilt, says the best thing is find something you're good at and then find somebody who'll pay you to do it. But you're going to have the basic capabilities. Motivation, I'll get to that in a moment. Determination, cannot give up. It could have been easy along the way many times in all of what you've done schoolwork. You didn't get to this school and do as well as you're doing by not being determined. Discipline. Let's take motivation and discipline together. Jim Collins wrote a book, Good to Great, and in there he talks about, and I'll paraphrase it, something along the lines of, well, how do you motivate or discipline people? He goes, you don't. You hire self-motivated and self-disciplined people, and that is very true. Humility. I know I used I or we today. I don't like to, but I had to because that was a story about something I did. Don't think about I or we or me. Think about we, not the I or the me, excuse me. Other directedness. I've always had the perspective that in a business situation, I need the other person more than they need me. And the last one, that 7th ingredient, not just because I'm on the campus of the University of Notre Dame, is luck. Luck trumps all of those other 6. And everybody will say, nah, that's not true. I've got these capabilities. I'm disciplined. Blah. Luck. I'm one of the luckiest people in the world to have had the career that I've had and meet the people that I've had. And the same thing's going to happen for you. Luck plays such a big part of it. You have to do the other 6, and then luck just happens to come along and help you get there. Let's end where we began. We talked about relevance. Let's end on personal relevance. Learn from the past, don't live in it. That's very important as you get further on in your career, and if you change companies and you go to a company as an executive, and the worst thing we can ever do is say, well, at blank company, we did it this way. And when I joined the Hershey company, it was a terrific storied tradition, and I said, we need to learn from the past. We can't pretend the marketplace is what it used to be. Perform effectively as a leader and as a team player, and as a CEO, many times people perceive it as, well, you're in charge, and you just tell people what to do. That doesn't work anywhere. It doesn't work at home, doesn't work at school, doesn't work at work. But oftentimes, if I had an executive team and there were 11 of us, I was one of 11 if we were working on long-term vision or strategy. But many times, one has to be one of 11 or 1 plus 10 because you have tough decisions to make. And you have to be willing, as we've said before, to make the tough calls. Willingness to put oneself in unfamiliar and uncomfortable situations. It's where we learn the most. It's where we capitalize upon our strengths, and it's how we grow. This is my most favorite. Do you create energy or do you sap energy? Every day we wake up and we have 2 choices a day. Are we going to create energy or are we going to sap it? As a leader, if you're an optimist, I can assure you the people with whom you work will be equally as optimistic. However, If you are a pessimist, I can also assure you they will be more pessimistic. So do you create energy? Do you sap energy? Communicate candidly and effectively. Bad news doesn't get better with age, but you need to have a couple of ideas how to fix the bad news you just brought to somebody. Is responsible, reliable, and trustworthy? Oh, yeah, of course I'm responsible, reliable, and trustworthy. That's what everybody thinks. And are you perceived as such? First half's easy. Second half is tougher. Anybody know what this is? Mouse ears. It all began with a mouse 90 years ago. Think about this. Walt Disney, 90 years later and still going strong. Talk about staying relevance. Thank you all very much. Thank you. We have time for questions, and there's something called a question box. No, it's not. It's a catch box. That is so cool. Anybody want to catch the box?
Right?
Yeah, you mentioned that when you had bad news come to that person that you're giving the bad news to with ways to fix it, who were the people that you looked to when you had to give that bad news out? Who are the people that you looked to help you problem solve?
That's a great question. The question was, when you had bad news and you had to fix it, who are the ones with whom you wanted to work with to help you fix it? Certainly those that didn't duck under the table looking for cover. It was those that you had worked with before in similar situations, meaning within the company, not outside the company, and they understood the severity of it, but they had a quiet confidence that they was going to find a way to do it. And there's no formula for it, but you can just tell when you engage in the conversation about here's what's not working, first identifying identifying there's a problem and what needs to be corrected, then you find the 2 or 3 people who are very much excited about attacking it. And many times it's not those who are directly part of what created the problem to begin with. There's just certain, we always call them go-to people in an organization that know how to get things done. And as a leader, you have to figure out which of those people you go to in that particular situation. Good question. Yes?
So you talked about when you go into an international market, you look for a partner that has that way to market. I was wondering, a step before that, how do you identify the good international markets to enter?
The question was, because when I talked about the flexible business system, and for Hershey it was find a partner that had a good route to market. How do you know which markets there are to identify? For confectionery it was easy. There's very good market research data that showed where per capita consumption was and where the potential growth was. And for Hershey, going into Western Europe, which would be high on the per cap consumption basis, but relatively low growth, entrenched competitors, very tough retail trade, it didn't make sense for us to start there. And we said, where can we go and learn as we go? Because Hershey was very inexperienced, and it wasn't that it was easy, but competition wasn't as stiff, and also particularly in markets for chocolate such as China and India, we thought we might have an opportunity within reason